Hi, this is Paspanojga from the Zimbabwe Monetary Institute, and our second video is going to be on bank creation of money. Okay, we're going to understand what bank creation of money is. We're going to refer to the Bank of England website, and then we're going to see that the banks were the only ones who were able to hyperinflate in Zimbabwe and elsewhere in Germany, in Hungary, wherever. Okay, so banks create money by using an accounting privilege or a banking custom. The Bank of England in 2014, Q1, they had a publication where they stated that banks created money. The commercial banks created money. In fact, in the United Kingdom, they said 97% of the money that's used in the United Kingdom was created by the banks, and only 3% was created by the government. You can also refer to the Positive Money campaign in the UK. They talk ad nauseum about the bank creation of money. So basically, if it's your first time hearing and knowing that the banks create money, that means whatever perception you had of the economy was probably wrong. The banks create the bulk of the money, and if you don't know what the banks are doing, you cannot understand what's going on in an economy. And the Austrians have one thing right about money, that the banks create money out of thin air. They do it by an accounting privilege. Here are the journal entries for that. They debit the loan account in the name of the customer. So what we're saying, this is the sub-ledger for any of you accountants. And the sub-ledger, in the loan sub-ledger, they debit the loan account in the name of the customer, and they credit in either the current account or the deposit account sub-ledger. They credit the money, they credit that customer. So they debit the customer, credit the customer, debit loan customer, credit deposit or current account customer. So what they do is they create a loan and deposit the money into the customer's account by creating a loan. In other words, they are increasing their balance sheet. If, for example, you were a person on audit in a bank, you have to know that the deposits aren't really real. The loans are real because that person will have to pay the money back. There are future cash inflows that are expected from that loan. But that deposit is not real. It's created by the bank. It's manipulated by the bank. It's just created by the loan. So when you're doing work, you do very little work on the deposits, but maybe do a lot of money on the advances and loans, and try to see whether these people are paying back the loans or whether these loans are real. So loans create deposits. Deposits do not create loans. What they're saying there is that they don't wait for someone to come into the bank and deposit some money before they can lend it. They first lend the money, and that creates the money in the account, the deposit in the account. So when they as they did in the hyperinflation, they debited the loan in US dollars and credited the bank account in Zimbabwe dollars in a hyperinflationary state. They basically they weren't lending out money that had been deposited, but they were lending money that they created out of thin air, and which the customer had about 24 hours to spend before it basically lost 90% of its value. And by doing that, they increase their balance sheets. So, so banks create money out of thin air. Why we so by a bank by an accounting entry, they create these bank balances, and these bank balances can be used to withdraw money from a teller when you walk up into a bank and go up and talk to a teller and swipe your card or show him a bank book, and the money is and then he hands money over the counter to you. Or you go up to an ATM and you put in your PIN number, put in your card, your PIN number, and draw money in that way. Or you go to a retailer, and instead of paying by cash, you use your card. You can write a check if you have a checking account and spend money that way. You can do what's called a real-time gross transfer, which is an electronic funds transfer from certain places, and that money will, what they do is they mark up one account and mark down another account, and money is transferred in that way. And this is the real bigger transactions are done like that. They don't involve money, they involve electronic money. So what's also important about this publication, because this subject was very hard to talk about before this publication in 2014 Q1. But it's now easy because the great granddaddy of them all, the Bank of England, has come and admitted that the banks create money, a thing that they have said was impossible, that money cannot be created by an accounting entry, that money, all the money came from the central bank. It says that banks are not mere intermediaries, financial intermediaries, i.e. they do not wait for grandma or grandpa to deposit money in a bank before they can lend it out. They simply do the accounting entry. And then there's the money multiplier, which assumes that the Reserve Bank controls the amount of money the banks can create. And that's not true. That's purely academic, and that's one of the myths that surround money. And then there's also that of fractional reserve banking, which is not really true, because it's just straight bank creation of money. They simply do it by accounting tricks. Okay, so a lot of people say, but this thing about bank creation, aren't the banks going to get in trouble? Yes, the banks do get in trouble, but the central bank or the reserve bank bails them out every time. It bails them out using a window where they simply come and get facilities. They leave collateral, which is just other forms of paper, and get real money from the other side of the transaction. This system works because of the interbanking system and the support of the central bank. That's why whenever a new reserve bank governor is going to be appointed, the banks say they want someone who understands banking, someone who has banked, and what they mean is it's an all boys club. They want one of theirs so that they can continue to benefit from the system, which is very little understood in the general public. As I said before, you cannot understand an economy unless you know what the banks are doing. And there is no information that is given to the general public on what the banks are doing. And also the banks, it is the provider, the main provider of money in the economy. And they're the ones that can hyperinflate. They're the ones that can inflate. They're the ones that can manipulate the economy without Jack and Joe seeing what is going on. I visited the Ministry of Finance. I went to one of the fiscal operations staff. She seemed very knowledgeable about banking. And we talked a bit, and when I talked about the bank creation of money, she asked me whether, are you joking? Showed her the publication, and her jaw dropped, and she seemed a little bit amazed. She went out and she says, oh, but for a few minutes, and came back and says, that explains a lot of things. And I asked her what she meant exactly, and she says, oh, in 2008, when the government moved away from the Zimbabwe dollar and dollarized, there was a zero monetary base. And then overnight, there was suddenly all these US dollars floating, and no one could explain to her where the money came from. Now she understands what happened. And also governments cannot hyperinflate because they create too little money. Banks use journal entries. They use a computer. And they can create, as long as you're sitting on the right computer, you can create an infinite amount of money. So we go back and look at some of these things and say, when did this bank creation start? Bank creation started just after the monetary reform in England, 1844. That's when it became more prevalent. That's when we have recordings of it. We look at people who were writing at that time. Henry Dunning MacLeod in 1866, in the Theory and Practice of Banking, noted that custom. And because in 1844, the House of Commons prohibited the banks from issuing paper. They actually issued money, physical money, paper money. And they prohibited the banks from doing that. But the banks who were in support of this legislation already knew that they could create even more money using banking entries. But that's a topic for another day. Harvard professor Joseph Schumpeter in 1954 wrote The History of Economic Analysis. And he says at the beginning of the 20th century, basically 97% of economists knew that banks created money. So this knowledge was in the public domain, but it has been hidden over the years. And again, bank creation is not fractional reserve banking, it is not money multiplier. It is just straight bank creation of money. Also, when we look at Henry Dunning MacLeod, he says when he was looking, bank balances rose dramatically soon after the Parliament passed this act. So the banks were quickly on the offensive and creating money, and it was benefiting them, because basically when a bank lends money, they say there are three F's. The three F's of banking. You got family, friends, and fools. So family and friends get all the good rates, good terms. Fools are the ones that get lent money. For example, when they created an asset, the loan, in U.S. currency, in a foreign currency, and they used the local currency, which they were hyperinflating, to give the customer, for the money that the customer would be given would actually be in the local currency, which was being hyperinflated, and the person would give up his asset, give up his collateral, and incur a loan in the US dollars or rands or South African rands or pound sterling. So we must focus on inflation now. And so hyperinflation is caused when the banks sponsor speculation of a currency against another currency. Milton Friedman says, when you want to understand inflation, you need to look at M3. You will see M3 shoot up. He says that in a video on YouTube. And soon afterwards, you'll have inflation. That is clearly the cause of inflation. It is that shooting up of M3. And also, to understand inflation, you need to maybe look at tulip mania, which was something that happened in the 1600s in Holland. We'll do that just after looking at this quote from Adair Turner, who's Lord Adair Turner, who was head of the British Financial Services Authority. He quoted former head of the Fed, who admitted that if the bankers were left to themselves with no adequate supervision, they would create an infinite amount of money, because the more money they create, the more interest they can make, the more influence they can have. Okay, the account of Tulip Mania you're going to look at is mainly based on Charles Mackay's account in his classic Extraordinary Popular Delusions and the Madness of Crowds of 1841. This is one of the better books on these delusions and these and it's a very well written book by the Scotsman Charles Mackay. So we're going to simplify this version for the purposes of this talk. I looked, the one in Wikipedia has changed a lot and has become so complicated that it looks like a stock exchange transaction when the stock exchange was not that complicated. They're talking about future contracts and all that, but this is a simplified version, which I've heard other people put on YouTube and on some radio shows and television shows that talked about it in this briefer manner. So what basically happened is mystery buyers appeared who started offering higher prices for tulips. Friends and neighbors found out that people they knew were buying these tulips and flipping them over for quick gain. There were no practical uses for the tulips except speculation. So between 1634 and 1637, the price of tulips rose exponentially. In 1636, 12 acres of land were sold for 2 bulbs of the tulip plant. When these mystery buyers vanished, tulip mania ceased and the prices tumbled. This is a speculation bubble. All the money power had to do was to finance or trigger the speculation. People would be doing it. And at the end, people would start to feel guilty and think that they caused the speculation by being greedy. But it's human nature. They were manipulated by the provider of the money. Those mystery buyers were funded. They didn't go out. They had no need for those tulips. They were there to do a human experiment. And that's what you have to understand. That is what inflation is. That is what hyperinflation is. That is what causes it. So to end our talk, we'll look at what our recommendations are for Zimbabwe. Zimbabwe needs to reissue a sovereign currency, prohibit the banks from creating money, and spend like crazy to make the country buoyant and to redo the infrastructure. I'm going to have a video, which will probably be posted soon after this one, on the recommendations that we have. But these are 3 main recommendations that we'll put at this time. Thank you very much for listening in. Please leave your comments and leave any suggestions in the spaces provided. Thank you very much.